Major U.S. stock averages turned higher Monday afternoon amid confidence about ongoing Fed stimulus support. Now, Ted, though, for much of the day, stocks were, of course, trading in the red, partly due to ongoing U.S. budgetary concerns, as well as the surprising announcement out of China of the government's decision to curb property prices. Now, does that worry change any of your fundamental investment thesis?
Well, I think what's changing my fundamental investment decisions is the fact that the market continues to show this strength. I mean, of course, we're not closed. We don't know where we're going to finish the day. But as we speak, you know, we were down most of the day, as you pointed out. We're now in positive territory. The tape to me looks pretty good. I like tapes like this. I like to see screens that are not all one color, all red or all green, but the screens are mixed and there's strength in the transports and some of the financials are acting pretty good. So the strength is coming from, in my opinion, the right sectors. I'm not sure that I understand it, and nor do I understand why the market is trading at the levels it's trading at, but it's a mistake to fight the tape. And those of us that do, and certainly I've been guilty of that more times than not of late, and therefore the surprise about how well the market does in light of all the issues that are still out there. You know, the tape just looks like it wants to grind higher, and we are clearly within shooting distance of these highs that we've been talking about. Now, at the end of the day, they're just numbers, but the fact is, maybe we're not getting there, but as far as I'm concerned, we're close enough. We're there, and then you know, we'll just have to see what happens going forward. But I think the market acts surprisingly well. I know you can make a case fundamentally in terms of value of the Dow and the S&P, where they're trading versus earnings, you know, versus a historical PE multiple for both those averages. And on a relative basis, you can make a case for the market really not being overpriced here. On the other hand, we're basically where we were in 2000, so we haven't gone anywhere. I mean, we've had a big move off the trading lows of March of 2009, but you know, that aside, and maybe it's not fair to take that aside, but that aside, I mean, we're basically right where we were in 2000. So for all intents and purposes, we really haven't made a lot of progress.
Now, a lot of people would argue that without the Fed support, and this week a lot of central banks will be announcing people expect ongoing support, accommodative support, that without that, the markets would be a lot lower right now. But how much do you think earnings could be responsible for that as well?
Well, the earnings clearly have been not remarkable, but have been very, very good for the last 3.5 years. And at the end of the day, it is earnings, in my opinion, that will drive stock prices. But you cannot dismiss for a moment the Fed's monetary policies, because basically they've created an environment of zero interest rates and almost forcing people to basically take on more risk, whether it is just to achieve income if you're retired or need income to live off of, or just to protect your assets from inflation. So Fed policies clearly have a lot to do with the stock market being at its current levels. You know, how much of it's stock market, how much of it's earnings, I really don't know the answer, but I would hope that it's more earnings than the Fed, because if I'm wrong and it's more the Fed, then clearly what the Fed is doing is creating a bubble in an asset class, similar to what the government probably did in the real estate market, going back to the time period before 2007. Let's hope that turns out not to be the case, because if it is, then the stock market's going to have a big problem. But that could be months, if not years away, because there's no indication, at least based on the last testimony of the Fed chairman, that anything is about to change anytime soon in terms of their policies.
And tomorrow, we've got the ISM services report ahead of the big jobs number on Friday. Any jitters about that?
Absolutely none. And the reason I say absolutely none is because there doesn't seem to be any jitters about sequester. There weren't any jitters about the fiscal cliff. And so, I mean, in the grand scheme of numbers and how important they are, I'm not sure that the jobs number or the ISM number are as important, as these two, bigger issues. And the market, for whatever reasons, and I'm not saying that I agree with it, but you can't fight the tape. The market, just for whatever reasons, has chosen to ignore these numbers. Where a year ago or 2 years ago, we would have lived and died with every one of these numbers. But that's no longer the case, other than, as we learned the other day, the eurozone. I think, and there's been no real improvement there, but if we start to get a series of negative numbers, negative financial reports out of the eurozone, which there's probably a strong likelihood that could happen, clearly that obviously is going to be a big negative for the market. Now, why that should have more of an impact than the sequester or the fiscal cliff or the ISM number or the employment number, your guess is as good as mine. But in terms of our domestic numbers, we just seem to be living in this bit of a bubble at the moment, and clearly something could change that. But as we speak, I'm not sure what it would be.
Thanks, Ted. This is Andrea Say reporting for The Street.